Hi, in this video, I'm going to talk about one of the three financial statements that should be very easy to understand, which is the cash flow. But because of the way it is presented in the annual report and the financial statements, is actually quite confusing. However, it is the most important statement that gives us really a true picture of what's happening in the business. So let's understand a little bit about the cash flow statement in this quick video. So first, let's begin by thinking about how do we as individuals keep track of our money. For instance, we may begin a month by looking at our bank statement and saying, okay, I have some money in my bank balance. Let's say it's 150,000. And then at the beginning of the month, you've received your salary for the previous month. So let's just say it's 200,000. So now your bank balance has increased to 350. And as the month progresses, you make some expenses, some operating expenses for your house, maybe rent or something, and then you spend some more on other expenses. And as you keep spending, your bank balance keeps reducing. And at the end of the month, you look at the balance in your account and say, okay, I began with 150, and the month has ended with 180. So I've kind of earned on a net savings of 30,000. Right? That's what I've made. Net of all my expenses, 30,000 is my profit for the month, as it were. Right? So it's pretty simple, because as and when we receive something in the bank, we know it's coming, and when something goes out, when you spend, you take it out of the bank, and you can quickly keep track of what's happening. So let's take a business that has, let's say, 1.6 million in the bank at the beginning of the month, and during the month they get 700,000 in terms of money from their customers. So 700K comes in, and then kind of there's an increase in the bank balance, and then there is some spending that has happened to create the products that they want to sell. Let's say it's 1.185 million. So the balance is reduced because you paid out your vendors, and then maybe there's some bank interest that you've paid because you've taken some loans. Let's just say it's 15,000, and in order to enhance your factory, you also had a capex of 600,000. So all of this put together cause now your balance to come down, and because your cash is coming down, you decide that, you know what, I need to borrow some money because I need money for my future. And let's just say you borrowed 300,000 from the bank, and you ended the month at 800,000. Okay, so you began with 1.6 million in the bank, and you ended the month with 800,000, and therefore during the month you've actually lost 800,000, right? You had a reduction of 800,000 in your bank. Now, if this is how traditionally businesses kept track of their accounts, however, we now have a more complicated system of accounting, in which most of these numbers won't be visible to you. Let's look at how this would be presented as the P&L and the balance sheet of the company. Okay, so this is the cash flow. You don't have to remember all the numbers. We'll come back to some of them, but there's a certain inflow and there's a certain outflow, resulting in a loss of 800,000 in this month. That's what has happened for this business. However, when we look at the P&L of this business, we'll actually see that there's a sale of 1 million. Remember, we collected only 700,000. We got only 700,000 into our bank. However, the P&L shows a sale of 1 million. So there's some different number over here. And then you actually look at the profit. The profit number is 200,000. So that's even more than you lost 800,000 in your bank. However, the P&L shows a profit of 200,000. And then there's certain things on the balance sheet that have changed. We can see that fixed assets have gone up, inventory has gone up, receivables have gone up, cash has come down. That's the only number which I think you can quickly correlate, right? 1.6 million has come down to 800,000 in terms of the cash on the balance sheet. Everything else, there are certain changes that have happened, which we'll look at. So the P&L and balance sheet in a way complicate the real story. But that's how it is. We can't change that. So how do we align these three statements, right? So let's kind of look at a quick alignment of these. So if you think about the three statements, so this was the cash flow. Remember, we saw this. There's a reduction of 800,000. But in the P&L, we saw different numbers. The P&L had a million of sales and a 200,000 of profit. Why is there this difference? That's clearly because the P&L recognized a million in sales doesn't necessarily mean that the money came into the bank. Only perhaps 700,000 got collected, and that we can see by looking at the changes that are happening in the balance sheet. So if you want to understand the difference in the sales number from a cash flow and what is presented in the P&L, I look at receivables. I find that my receivables have gone up from 1.2 million to 1.5. So what it means is that at the beginning of the month, I had 1.2 million of receivables. During this month, I sent further invoices of 1 million to my customers, or I sold another 1 million. So that's 2.2 million. But at the end of the month, I have 1.5, which means that I collected 700,000. So the collection of 700,000 is what shows up in cash flow, because that's the money you've received, whereas the P&L tells you all the invoices that you raised, which is 1 million. And the difference between the beginning receivables and the end receivables, which is 300,000. So receivables have gone up by 300,000. Therefore, my cash is actually 300,000 less than what the sales represent. So you can see that mapping, that increase in receivables means that my cash inflow is lower than what my P&L is telling me. Similarly, we look at the operating expenses. My P&L is saying only 685,000, but my cash flow is much more. Why is that happening? That's best found by looking at perhaps my inventory. My inventory at the beginning of the month was 1.9, and it's now gone up to 2.4, which means that I have produced more than I have sold. So I've actually added 500,000 to my inventory, and that's why I have produced worth 1.185 but sold only 685. That 500,000 difference is the increase in inventory, is what is showing up as an impact on my expense. The interest expense is the same, so there's no difference here. The same thing when it comes to capex, right? So 100,000 is what is showing in the P&L. That's a depreciation. The depreciation was 100,000, but I actually spent 600,000 in cash flow. What's happening over here? I had 5 million of fixed assets at the beginning. It should have come down by 100K because of depreciation. I used up about 100K worth. So it should have been 4.9. But it is increased to 5.5 by the end of the month, which means that I've added new assets worth 600,000. So I've added 600,000, I've paid for it, and that's showing in the fixed assets change. And the debt, right? And the debt increased from 1.4 to 1.7, and that's kind of the borrowing. The fact that I've increased my debt is not reflected in the P&L because it probably didn't have an immediate impact. Maybe next month's interest expense will go up. So here's where we've gotten to. So this is the changes that we saw, but unfortunately, it's not presented in as simple a manner as I have just shown you. So let's look at how the cash flow statement is actually shown in the annual report. It's a little complicated, but if you can maybe use the numbers that we have here and just follow. So the cash flow statement typically starts from the P&L profit, because that's the number that everyone remembers. 200,000 was our profit. We add back depreciation because depreciation is not a real cash outflow, so the profit has been understated. Here, interest expense is also added back in the first part because interest is not an operating expense; it's part of your balance sheet capital. So to arrive at the operating cash flow, we add back the interest expense, and then the changes in the working capital. Right? So we saw that there was an increase of receivables of 300,000 and 500,000 increase in inventory. Payables was the same, so there's no impact of it. So there's an 800,000 increase in working capital, which is a reduction of cash. So all told, we have cash flow from operations of a negative 485, which means that during this month, our operations consumed 485,000 of cash, because most of it went into building inventory, new inventory, and some of it went towards increasing our receivables. But that's not the only thing that has happened. We also spent money on capital expenditure, and there could be other investments at 600,000, which is now categorized in a separate bucket called cash flow from investing activities. So that's minus 600,000. And then you have what is happening on the capital side of your balance sheet, right? On your liability side. So an increase in debt of 300,000. So that's an inflow of money, but there's also an outflow of interest towards the debt that you have to pay. So that's a net impact of a positive 285,000, which is coming from financing, which is related to your capital rated. So if you raise equity, you would add it over here. If you give out dividends, you take it out here, right? So those categories of items are put in this. So net, you can now add them up and find that the change in the cash in that month is minus 800. So minus 485 minus 600 plus 285 gets you to minus 800, which is what we saw in the cash flow. So the cash flow is an integral part of the P&L and the balance sheet. It actually tells you in real terms whether you've made money, whether you got money into your bank or not. The P&L and balance sheet can give you slightly misleading information, but between the P&L and balance sheet, we can understand what's happening in the cash flow. So the three are interconnected. They're designed to be so, and therefore, if you want to really understand what's happening in a business, I would actually start by looking at the cash flow statement and then go to the P&L and the balance sheet and see the three of them as one integrated whole. I hope this was a useful explanation of what's happening in the cash flow statement. And if you have any questions, of course, do reach out to us. We have wonderful courses on the topic of financial acumen where we go deep into this and give you an opportunity to learn in an interactive manner. So do check out our courses and subscribe to our YouTube channel so that you can keep watching our videos on strategy, finance, leadership, and many more topics. Till next time, see you.